A very good morning, guys. This is our section where we will be dealing with the component that affect our gross income. The first component that I would like to discuss is that of our total amount, which apply our case law. So we'll refer to our case law as it is not defined or discussed under our section 1 of our Saica legislation. Now, our total amount component, there's two specific cases that are applicable under this component of our gross income. The first case that we look at is that of our Latahan and the principle which was established under our Latahan by the court. So under our Latahan, the principle states that the word amount must be given a wider meaning and must not only include the money but the value of the property that is earned by the taxpayer. Now when we talk about property, we basically referring to the property that could be tangible, intangible, our rights that we have or that have been earned by the taxpayer, which need to be included in the taxpayer's gross income when determined objectively in relation to the market value. The example here that I can make is when the taxpayer is receiving a payment in a form of a trading stock. Okay, so you can see here that the manner in which we are receiving a payment is not in a form of money. Therefore, we can determine the value of that stock in relation to market value and will then be included in the taxpayer's gross income. Now, the second case which we need to look at is that of our butcher bruise, where basically we said that it might be difficult to determine the money that is attached to the transaction that you are dealing with, but it does not necessarily mean that the amount does not exist. Okay, so the other important concept that we need to look at here is that of our concept where we are saying that the onus is on the commissioner to prove that the amount actually exists, and we also say that the notional amount will not constitute our gross income, which means that play meaning not real. So such cases, then you will not include those into our gross income. It might be noted that later when we are dealing with our accrued tool, we will look at closely the concept of our non-accrual, which is an unquantifiable amount. So the unquantifiable amount, the unquantifiable portion will not be included into gross income. Only the portion that will be quantifiable will be included into gross income. Okay, but then that we will deal with when we are dealing with our accrued to component. Okay, for now, what I'm saying is under our butcher products case, we are basically looking at the two important concept where we are saying that sometimes it is difficult to determine the money value that is attached to the transaction, but it does not necessarily mean that the amount does not exist, and we are saying that the onus is on the commissioner to prove that the amount exists, and we are saying that gross income does not constitute the notional amount and will not be included in gross income. And then the next component that we need to look at is that of our in cash or otherwise. Okay, now under in cash or otherwise, we are saying that it is not only receipt or the accrual of money that may be included into gross income. We do include the asset that have been received or been earned by the taxpayer, which could be determined objectively in relation to market value. So when you are receiving some sort of a payment in exchange or in some sort of a barter transaction, then those assets that you are receiving that can be determined in relation to the market value will be included in the taxpayer's gross income. Again, under our in cash or otherwise, there's two cases that are involved. The first one is that of a Latahan. So you can see a Latahan case, it appears both under total amount as well as under in cash or otherwise. So the total amount case, then the court held that gross income was not only confined to money but does include the value of the property which is earned by the taxpayer. Such property, it can include debt or rights of action that have been earned by the taxpayer. Okay, remember it need to be determined objectively in relation to market value. Okay, and then the next case then, which is under our in cash or otherwise, is that of our Brumeria case. Now the Brumeria case, it deals with the concept of an interest-free loan. So Brumeria obtained the loan which was free of interest from the retired people. Okay, so the court established a principle, or it held that the right to retain and use borrowed funds without paying an interest, it had a monetary value attached to it, and that right was supposed to be included into the gross income of the taxpayer. So if that right is given in exchange for a quid pro quo, so if they have to be a quid pro quo that is given in exchange for an interest-free loan in order to be included into gross income. So what I'm saying is the court went on with this judgment where it said that the application of our Brumeria will only be used when there is a quid pro quo that is present in a scenario. Okay. And then the third part, the third component that we'll look at is that of our received by and our accrued to, but we'll split it into two. So we'll deal with our received by separately and our accrued to separately. So under our received by, we looked at the timing of accruals, and there's two main specific principles that is attached to this received by component. The first one is that of our the accrual principle, when we are saying that our gross income is recognized at the earlier date of receipt or accrual, and then the second one is that of our beneficial principle, where we are stating that the amount is received by the taxpayer on his own behalf for his own benefits. And the first case that apply, or that is based on this beneficial principle, is that of our Gelden Hayes, where under our Gelden Hayes case, the court established the fact that the amount which is collected or which is received by the agent on behalf of a third party will not be included in the agent gross income. The agent is only taxed in relation to the commission that he received as a sort of a payment from the principal owners. Okay, so what we are saying is that the balance of the amount that is received by the agent is in a trustee capacity, therefore the owners won't be taxed. So the agent is only taxed in relation to the commission that he's receiving for performing that service for the owners. Okay. Now, the other cases that we looked at under our received by is the one that deals with some theft or fraudulent activities. So the one that we look at first is that of our MP Finance, that deals with the illegal businesses of such, okay, which is also covered in week 4 of our capital versus revenue, when we look at our illegal activities. Okay, now under our MP Finance, we looked at the deposit which were taken under a fraudulent pyramid scam. Okay, so the court held that the deposits which were taken under a fraudulent pyramid scam, they were received by the taxpayer as the taxpayer intended to receive such amount. Okay, so those deposits then were included in the taxpayer's gross income in that year of assessment that the taxpayer received those deposits, even though the operators of the scam, they were legally liable to return those deposits to the investors. Okay, however, since they had an intention to receive such deposits, the amount was included in the gross income of the taxpayer. Okay. Now, also in terms of the MP Finance, let's say for example that the taxpayer, for example, is operating a business, and then he then becomes greedy of such by charging the customer extra than what he's normally charging the customers. The extra portion or the extra amount, then we'll say that it is received by the taxpayer as he intended to receive such amount, and should should be included in the taxpayer's gross income because he's receiving such income for his own use and benefit. So you can see here also that our MP Finance, it's also using this principle of our beneficial principle. Okay, so it must be noted that the deposits under this case that were obtained under the fraudulent pyramid scam, the taxpayer intended to receive such amount and therefore will be included in the taxpayer's gross income. Okay, and then the next case which we need to look at is that of our Dalgo Bay cigarette, where there were some sort of illegal activities that were involved in the situation. So the court had its view, and then SARS also raised its view. Now the court said that the legality was irrelevant of the amount which was collected by the taxpayer, and such amount will be taxed or the tax is subjected to the amounts that are collected under illegal activities. Okay, so we need to take note of the fact that even though the amount are being obtained under some fraud or theft or stolen monies, court is saying that you will be taxed on those amounts. Now SARS also supported that by saying that the thief will be taxed on the stolen money. So those were key principles that we learned under our Dalgo Bay cigarette. Okay, now the next case which we need to look at is that of our association racing club, our VIT case, where they made a donation to the charity organization. Okay, so the principle there, it was held that the commissioner was correct to treat such donation or to tax the donation under the association, because the association was not bound to make such the donation to the charity organization. It merely had a moral obligation to do so. So what we are saying here is that the burden of paying tax, it will not fall in the hand of the receiving party, but the person who made the donation, which is the association here, will be taxed as a result, because the association was collecting these monies for its own use. It merely had a moral obligation to make the donation to the charity organization. Okay, and then we need also to discuss then the concept of the deposits. Okay, now we are saying that the deposits are not actually loans. Okay, we need to distinguish between loan monies and the deposit. Normally the loans, they have an obligation to repay, whereas the deposits, they are sort of contingent to a future event and they are conditional. Okay, so in that situation we are saying that the deposits, you can perform or render services in exchange for the amount that you have received, as opposed to the loan monies, where you have to pay the principal amount. On top of the principal amount, you must pay an interest. So there is a difference between our loan monies. Our loan monies is some sort of the loan monies, we're saying that they have an obligation to repay, whereas the deposit, it's some sort of a prepayment for the services that you are expected to render or perform with regard to that amount that you have actually received. Now the case that we look at here is that of our pirate case that dealt with the concept of our biscuits and the tins. Okay, so in this case then we looked at the deposit. We are saying that there is a general guideline that is attached to the deposit, where we are saying that deposits are generally revenue in nature, arising from the ordinary cost of the trade, and the receipts that is arising from these deposits are treated as revenue and are supposed to be included in the taxpayer's gross income, unless there is a separate trust account which is created by the taxpayer. Under those circumstances, then if there is a separate trust account, the deposits then for the refund that we expected to give to the customer, if the customer did not claim, they will be classified as capital in nature if there is a separate trust account. However, if the deposits are freely mixed with other income that you are receiving under the business that you are operating, then the deposit will be classified as revenue in that instance. Okay, so what I'm saying is the hard work is not the creation of the accounting provision, but a separate trust account. So if you have a separate trust account that you have created created specifically for the deposit, then those deposits will not be included in the gross income in that relevant year of assessment that you are receiving those deposits. Okay, so those are the very important things that you need to watch out for when you are dealing with the deposits. Okay, then we need to look at the concept of our accrued to. Now, when we are looking at our accrued to, we are basically looking at the two specific cases that were established by the court. The first case is that of our People's Store, where we look at the outstanding debts that have accrued to the taxpayer. We said that those outstanding debts, they represent an amount which had accrued to the taxpayer and are supposed to be included in the taxpayer's gross income. That's the case of our People's Store. But there was an extension to this case. The case was extended under our MOI, where we looked at the concept of unconditional entitlement. Okay, so the case of our People's Store, it deals with an entitlement principle, whereas in terms of our MOI case, then there's an extension to the case of our People's Store. We are saying that the accrual, the taxpayer becomes entitled, or the amount is accrued to the taxpayer when he becomes unconditionally entitled to the amount, where there are no condition attached to that amount. Okay, so that is the principle which was established under our MOI case. And then what we also need to look at is the concept of your non-accrual that I have mentioned earlier, but now we need to look at the non-accrual greatly here, where we talked about the unquantifiable amount, where we are saying that maybe, let's say for example, let me make a nice example here, where you are basically performing a service to a customer, and then the customer make some payment to you of 9,000, and then promise to you that he will also pay you a 10% on the amount that is going to generate from the production that will result from using a particular machinery. Obviously, in the next upcoming year, you don't know how much revenue will be generated from the use of the machinery of that asset. So such income, you can see that it is unquantifiable at the time when the customer is making this 9,000 payment. Therefore, the 10% payment that the customer will be making to you is in some sort of an unquantifiable portion. Therefore, the unquantifiable portion will not be included in the gross income at that time. You'll only include the 9,000. The unquantifiable will only be included when it becomes what? Quantifiable. Okay, so it's very important to be able to deal, or to be able to interpret the concept of non-accrual or unquantifiable amount. Okay, now the other thing which I also wanted to discuss here is that when we are dealing with our trade discount, settlement discount, or such. Okay, so let's say that you are giving a settlement discount to a customer. Okay, so if there is a settlement discount that is offered to the customer, we are saying that the amount in which you will recognize as a receipt or as an accrual after delivering or after satisfying a performance obligation to the customer is only the amount that exclude the settlement discount, because the settlement discount will only be taken into account when the date of claiming that discount have passed. Now, depending whether the customer claimed or took advantage of the discount, then you will decide from that date whether to include it as an accrual or exclude it on your gross income. So let's say, for example, that you sold goods to the customer, and we have made the delivery on the 1st of July 2019, and then you are promising that the customer, if the customer take advantage of the settlement discount on the 24th, then you will give the customer a settlement discount of 1,000 from the 10,000 goods that you have sold. So if the customer claim they did a discount on the 25th of July, you can see that you will only recognize the amount. You are unconditionally entitled to the 9,000. The 1,000, the customer have taken advantage of that settlement discount, so it will not be included in your gross income. However, if the customer, if the date of claiming the discount passed without the customer taking advantage or making the payments on that date, then you can see that the amount of the discount portion then becomes it accrues to you on the date if the customer does not take advantage of the discount. So you have to be very, very careful in terms of the date as well that are involved in this particular transaction. Okay, now we also need to look in terms of the trade discount, and as we know, the trade discount, it is an upfront discount that you basically give to the customer. So if there is a trade discount that is involved, then the amount which you will include in your gross income, it will be the net selling price, which is basically the selling price less the trade discount that you have offered to the customer. Okay, so I will basically stop here with regard to the discussion of our gross income component, and the rest of the component I will discuss on our next session, where I will be discussing greatly the other component that are involved. For example, our deemed accrual, which apply our section 7, which is then defined greatly in our Saica legislation, where we looked at our section 7 subsection 1, where we look at the income that have accumulated or that is invested in the taxpayers in his own use and benefits, where we looked at in terms of our section 7 subsection 2 little b, where we looked at some taxpayers who are trying to avoid or reduce their tax liability by shifting the excess income into their spouses. But I will discuss that in greatly in our next session. Make sure that you listen to this video 2 or 3 times to make sure that it sink in, so that you are fully prepared for your test 1. I thank you.